Sarah buys a duplex. Daniel opens a brokerage account. Both of them are convinced they made the right call. But here is the part that changes everything. Neither of them calculated the full cost. Not the mortgage, not the fees, not the hours, not the tax, the full cost. And when you actually finish the math over 25 years, the number sitting at the end will completely change how you think about both of these decisions. Let us make this comparison completely fair. Sarah and Daniel are both 30 years old, both living in the same mid-sized city, both earning $60,000 a year, both disciplined savers, and both sitting on $60,000 in savings they are ready to put to work. The only variable is the decision they make with that money. Sarah uses her $60,000 as a down payment, 20%, on a $300,000 duplex. She lives in one unit and rents the other. Smart move on paper. She takes out a 30-year mortgage at 7.5% interest. Her monthly mortgage payment comes to approximately $1,670. She finds a tenant for the second unit at $1,400 a month. On paper, Sarah is almost covering her entire mortgage with someone else's money. She feels like she cracked the code. Daniel takes the same $60,000 and puts it into a total market index fund. No property, no tenants, no mortgage. He sets up an automatic monthly contribution of $400 and goes back to living his life. His colleagues ask what he invested in. He says index funds. The conversation ends immediately. Day 1. Sarah has a property, a tenant, and a plan she can explain to anyone. Daniel has a confirmation email and a portfolio nobody wants to hear about at dinner. The feelings are not even close. But this video is not about feelings. For the first 2 years, Sarah is genuinely winning, at least on the surface. Rent hits her account every month. She is living in her own property. She is building equity. She is claiming depreciation on her taxes. Comparable properties in her neighborhood are ticking upward. Every part of this investment feels real, physical, and intelligent. Daniel logs into his account once a month. The number moves up a little, then down a little, then up again. There is nothing to point at, nothing to show anyone, just a number on a screen that is doing something very quiet and very powerful underneath. Now let us talk about what Sarah is actually dealing with, because the brochure version of landlording and the operational version are two completely different documents. Vacancy. Even a well-managed rental unit sits empty for 3 to 6 weeks between tenants. That is not worst case. That is industry standard. During that period, Sarah is carrying the full mortgage with zero rental income to offset it. Maintenance. The standard budgeting rule for rental properties is 1 to 2% of the property value per year. On a $300,000 duplex, that is $3,000 to $6,000 annually. And that is in a normal year. Not the year the boiler fails. Not the year a tenant leaves and takes the kitchen cabinet handles with them. Capital expenditures. Roofs. Vac systems. Plumbing stacks. Water heaters. These are not surprises. They are scheduled future costs that most new landlords forget to account for, because they are invisible until they are not. A roof replacement on a duplex runs $10,000 to $18,000. You do not get to postpone it. Time. Sarah is managing this herself to protect her margins. That means responding to maintenance calls, coordinating contractors, handling lease renewals, running background checks on prospective tenants, conducting inspections, dealing with disputes. A conservative estimate for self-managed landlords is 5 to 8 hours per month in a smooth year, more in a difficult one. That time has a value. Most landlords never assign it one. Let us run the actual numbers through year 3. Sarah has collected approximately $50,400 in rent over 36 months. Her mortgage payments total roughly $60,408. She is house hacking, so she is not paying separate rent elsewhere, which means the mortgage payment is partially replacing what she would have paid to live somewhere. That is a genuine advantage, and we will keep it in the calculation. But her actual cash outflows beyond the mortgage tell the real story. Property taxes, $30,600 per year in her market. Insurance, $2,000 per year for a duplex. 1 vacancy period, $1,400 in lost rent plus $800 in cleaning and relisting costs. A water heater replacement in year 2, $1,500. Miscellaneous maintenance, averaging $2,200 per year. After 3 years, her actual net position from the rental income side, after all real costs, is approximately break-even to modestly positive. Between $1,000 and $5,000 net, depending on how the year went, not the clean profit the initial numbers suggested. Daniel at year 3 has contributed $60,000 upfront plus $14,400 in monthly contributions. At a 10% average annual return, his portfolio is sitting at approximately $89,000 to $95,000. 0 phone calls, 0 contractor coordination, 0 weekends lost. But Sarah has something Daniel does not. Her $300,000 property has appreciated 3 to 4% annually and is now worth approximately $328,000 to $337,000. Her remaining mortgage balance is around $278,000. That puts her equity at roughly $50,000 to $59,000, much of it built using the bank's capital. That is leverage. And it is the single most powerful structural advantage real estate has over stocks, at least in the early years. By year 7, something is shifting underneath both portfolios, but only one of them can feel it. Sarah is on her 4th tenant. She has replaced the HVAC system, $7,200 she did not budget for in year 1. She has raised rent twice and is now collecting $1,600 per month. Her property taxes and insurance have both increased. Her cash-on-cash return, the actual money she pockets relative to the cash she invested, is running between 4 and 7% after all real expenses are accounted for. Not bad, but not the number she quoted people at the beginning. Daniel has done precisely nothing except not panic. His portfolio has grown to approximately $175,000 to $195,000, including his ongoing $400 monthly contributions at roughly 10% average annual return. The compound growth is beginning to accelerate. The gains on his gains are now generating more new wealth per year than his original contributions ever did. This is the part of compounding that is impossible to feel in year 1 and impossible to ignore by year 10. Year 10. Full decade. Let us count everything. Sarah's duplex is now worth approximately $400 to $430,000. Her remaining mortgage balance is around $248,000. Her equity position sits at roughly $152,000 to $182,000. Over 10 years, she has collected significant rental income, but she has also paid out property taxes, insurance, maintenance, capital expenditures, and vacancy costs totaling somewhere between $85,000 and $110,000, above and beyond her mortgage payments. Her net cash flow profit over the decade, after every real cost, is likely between $15,000 and $35,000, depending on her market and her luck with tenants. Total wealth position, equity plus net cash flow, approximately $170,000 to $215,000. Daniel's portfolio at 10% average annual return with $400 monthly contributions is sitting at approximately $195,000 to $215,000. He invested $60,000 upfront plus $48,000 in contributions, $108,000 total. Everything above that is compounding. At year 10, they are within striking distance of each other. But here's the part that changes the comparison completely. Sarah spent hundreds of hours managing her property, took on $240,000 in debt, concentrated her entire investment position in a single asset, on a single street, in a single local economy. Daniel is diversified across thousands of companies globally. His investment is completely liquid. He can access it in 3 business days. He has not lost a single night of sleep over it. Same approximate wealth. Radically different paths to get there. Now let us jump to year 25, because this is where the math becomes genuinely uncomfortable for whichever side you are rooting for. Sarah's duplex, assuming consistent 3 to 4% annual appreciation, is now worth approximately $560,000 to $620,000. If her mortgage is paid off or nearly there, her equity is $540,000 to $600,000. 25 years of rental income, minus 25 years of taxes, insurance, maintenance, capital expenditures, vacancy, and time, produces a net cash flow position somewhere between $60,000 and $120,000 in total profit above all costs, possibly more in a high appreciation market, possibly less in a flat one. Total wealth position, $600,000 to $720,000. Daniel at 10% average annual return with $400 monthly contributions over 25 years, his $60,000 has grown to approximately $730,000 to $790,000. Total contributions, $60,000 plus $120,000 in monthly contributions, $180,000 invested over 25 years. Everything above that is compounding, doing what compounding does when you leave it alone long enough. Zero debt, zero concentration risk, completely liquid. And if Daniel had increased his monthly contribution by even $150, bringing it to $550 per month, his 25-year portfolio crosses $900,000. In the stock market, increasing your contribution has a multiplied compounding effect. In real estate, increasing your investment typically means buying another property, another mortgage, another set of tenants, another set of midnight phone calls. Now, if I only showed you the numbers that favor stocks, I would be doing exactly what I am criticizing. Stocks have real risks that compound investors prefer not to talk about. Volatility is not abstract. A 35% market drop, which has happened multiple times in modern history, on a $200,000 portfolio means watching $70,000 disappear on paper in weeks. The research is consistent on what most retail investors do when that happens. They sell at the bottom. They buy back in after the recovery. They lock in the loss and miss the rebound. Compounding only works if you stay in the position. There is no monthly income. A rental property generates cash flow you can spend. An index fund at $200,000 with a 1.5% dividend yield pays you approximately $250 per month. That does not replace income. For investors who need current cash, real estate has a structural advantage stocks cannot replicate at equivalent portfolio sizes. There is no leverage equivalent. Daniel used $60,000 to control $60,000 in assets. Sarah used $60,000 to control $300,000 in assets. That 5-to-1 leverage ratio is the engine behind real estate wealth creation, and it is genuinely unavailable to index fund investors at the same scale. And depreciation. Real estate investors can deduct the theoretical decline in their building's value against their taxable income, even while the property is actually appreciating in the real world. That is a legal tax shelter with no equivalent in equity investing outside of retirement accounts. Real estate is not a bad investment. It is a misunderstood one, usually in both directions simultaneously. It wins clearly when the rent-to-price ratio in your market is strong, when monthly rent is at least 0.8 to 1% of the purchase price. In that environment, the cash flow math supports you from day one. It wins when you treat it like a business, with tenant screening systems, capital expenditure reserves, defined processes, and a realistic accounting of your own time. It wins with house hacking, the strategy Sarah used, where you eliminate or dramatically reduce your own housing costs while building equity. The stock market cannot do that, and it wins significantly with tax deferral strategies, specifically 1031 exchanges, where you roll gains from one property into the next without triggering capital gains tax. That kind of tax-deferred compounding in real estate can rival or exceed what index funds produce in taxable accounts. Sarah and Daniel both walked away from their decision confident they had made the right call. Sarah thought leverage and tangible assets were the proven path. Daniel thought compounding and simplicity would do the work for him. Neither of them sat down and calculated what their choice would actually cost. In dollars, in time, in stress, in concentration risk, and in opportunity cost. Over 25 years, the math lands them in a similar place, but how they got there is completely different. Sarah worked for her wealth. Daniel waited for his. Sarah had control, leverage, and cash flow. Daniel had liquidity, diversification, and peace of mind. Neither of those outcomes is wrong. They are just different trades. The real mistake, the one that costs people the most, is choosing between them based on what sounds impressive at a dinner party, what trended on social media last week, or what someone told you worked for them in a completely different market at a completely different time. The only number that matters is the full number, not the rent check before expenses, not the portfolio balance before contributions, not the equity before the debt, the full number, calculated honestly. For your situation, and if you want to know what happens when you do both simultaneously, when you hold index funds and own property at the same time, that calculation changes the outcome for both of them in ways most people have never seen mapped out. That is the next video. But before you go, the next time someone tells you real estate always wins, or stocks always win, ask them one question. Did you count everything? Because the answer that counts everything is the only answer worth listening to.